All right, let's start with some basic definitions. First of all, what is hedging? Hedging is a way to limit risk by taking a trade in the opposite direction in a related asset or the same asset. So let's say that you bought a stock. You could buy an option on the stock, which would make money if the price went down. So you would be long the stock, but you would have that downside protection with the option. Or you could sell some of that same stock short in another account, and that would cover some of your downside risk also. So that's a way of limiting your risk and at the same time taking advantage of the direction that you think that asset is going to go in. Now, this risk reduction might not be a total loss. You could actually profit from that, and that's what we'll talk about a lot in this program. So keep in mind that the hedge can actually be an advantage for you. Now, international companies use hedging to limit their foreign exchange risk. So take BMW, for example. They're selling cars in different countries, and those currencies can fluctuate over time. So they want to protect themselves in case one currency gets too cheap or too expensive, and they have a department that hedges their risk on the currency exchange. So that's one way that big companies use hedging in their day-to-day operations. Another area where companies use hedging to limit their risk is if they're a large corporation that uses a lot of commodities. For example, gas or lumber or things like that that could go up in price significantly, they're going to hedge that. So for example, an airline would lose money if their fuel cost is too high. So they could use some futures or options to make some money if the price of fuel goes above their profitable price or even before that. So that's another way that big companies use hedging to limit their risk. And finally, you may not know this, but hedge funds were founded on the principle that they're going to be hedging their positions. So they were supposed to be slightly safer investments, but that's no longer the case anymore. A hedge fund doesn't have to hedge, but they were founded on that principle, and that's why they're called hedge funds. All right, now I've shown you that hedging works for big corporations and large funds, but what about independent traders like us? Well, retail Forex provides an easy way to hedge without expensive options or futures contracts or complicated transactions. Another great thing about retail Forex is that it can be easily traded long or short. It's the only market that the small independent trader can easily do this in, and that's why this program is targeted directly at retail Forex. This is not for futures, not for stocks, not for crypto. This method will only work in the Forex market. And I kind of mentioned this before, but it's worth repeating. The transaction costs are so low that even if you have a small account, let's say like $500, you can still do this without incurring a lot of transaction fees. And a great benefit of hedging in Forex is that you can get an excellent feel for the movements of a particular currency pair. So let's say that you're trading the pound dollar, and since you don't have to necessarily enter and exit the pound dollar at certain prices or with a certain system, you can kind of take some off here, take some off there, put some more on here. You'll get a really good feel for how the pair moves, and that can help you with your hedging, but it can also help you in developing other trading systems in the future. Now let's get into the most common misconception around Forex hedging. If somebody doesn't know about hedging, they'll email me, they'll show me a spreadsheet, and they'll show me why hedging cannot work. And it usually goes something like this. So for example, we'll take this trade, and we'll take one lot short, one lot long at the same time. And then let's say that the price goes down 77 pips. So from that green line is where we entered, and the dotted line above 77 pips is the current price. So they'll tell me, okay, so the short made $770, the long lost $770, and the net profit is zero. So what the heck? How do you make any money from hedging? All right, so here's the solution. There are three ways that you can go about this. First, you can do a percentage hedge. That just means that you are not doing one for one. You're doing a percentage. Maybe you'll have one lot long, but you only have a percentage of that short to cover your downside, or the opposite, right? You might have one lot short and you only have a percentage of that long to cover the price going up if you're looking to go short. So another way to do it is to do the covered hedge. I'll get into that in a second. And then you could actually do the full hedge like I showed you before, but if you know how to enter and exit, you can profit from that situation also. All right, so here's the percentage hedge. Like I mentioned, you're going to go short one full lot, and instead of taking one full lot long, you might take a 0.25 lot long, because as you can see, price is hitting a resistance level, and it's probably more likely to go down. So if you want to bet that it's going to go down, you would take one lot short and then only take a little bit long just to cover your upside a little bit. So in this case, you could take 1 lot short, 0.25 lots long, and when price goes down 77 pips, you could take a profit on the short. So you close out the entire 1 lot and you would make $770. Then you would close out the entire long position, the 0.25 lots, and you would lose $192.50 for a net profit of $577.50, and your position would be flat. So in this case, you would make a profit on the net, but you would also cover your upside without a stop loss. Okay, so this is the covered hedge. So another way that you could do this is you could go short 1 lot at the current market price, that green line. But instead of putting a stop loss in, you could have a pending 1 lot long if price goes above this double top. So if you're wrong about the direction, you could have a pending long above that. And if price starts to go up, you could make money even if you were wrong. Now, if in this case, if price went down 77 pips, obviously you would take that full profit. You would make $770 and you would have 0 positions after you close that out. And finally, we'll come back to the original example where you do a full hedge, where you take 1 lot short, 1 lot long at that green line, and then you'll do what I call a roll off. So price drops 77 pips. So you're going to take a profit on the full 1 lot at $770 profit. Then you'll only take a partial loss on the long position. So you'll take, let's say, half of that off. So you'll close 0.5 lots and you'll lose $385. So the net profit on that transaction will be plus $385. So that's something you bank that goes into your account. And then obviously you'll have a floating loss now because you'll still have 0.5 lots long, right? So you have a floating loss of negative $385. And that's where people stop because they're not thinking ahead. They're not thinking creatively. And they haven't taken this program. So from there, what you can do is you can hedge again, right? You could actually put on another maybe 1 lot short to hedge this long position, or you could put on 0.5 lots short and be 1 for 1 again. And that significantly reduced your initial position of 1 lot long, 1 lot short. And now you're down to half. And then price can move around again. You can take a profit, roll off part of the loss, and then re-hedge again. And that's how you make money, even if you have a full hedge on. So as you can see, roll-offs are the key to success in this method. A roll-off is when you offset an existing losing position with a gain, and you don't take the entire loss, but you take part of it off so that it nets out to a profit. This allows you to gradually close out losing trades at a net profit instead of taking the entire loss at once. And this can have significant psychological benefits because you're not taking that big loss and you're not having this big drawdown of losing trades, but you're taking off the losing trades gradually at a net profit, which can be psychologically easier to handle for some people. So it really helps to set a percentage that you're going to roll off. I like 50%, so I'll take 50% of my profits, and if there is a losing trade, I'll take off that money from the losing trade. If there isn't a losing trade, then I'll just take the entire profit. All right, so that's how we make money in hedging. I'm going to get into this more in depth throughout this course, so if you didn't get that the first time, don't worry. Just go back and watch this video again and then go forward and watch the other videos because they will explain it in more detail. But let's review the benefits of hedging again because I didn't mention some of these things in the beginning, in the first video. So number 1, it's extremely flexible. You don't have to be set into certain rules. You don't have to have a set system. And in fact, you can actually do a random entry and still make money. Now that's not ideal because a set entry method can give you some advantages right off the bat and you could see yourself in profit faster that way. But for people who don't like to be locked into those types of systems, this can be a great way to trade. Next, it prevents you from getting stopped out. Like I mentioned, psychologically, that can be easier for some people because you're not having these losses in a row and you're not having these big drawdowns, whereas you're removing the losses slowly over time and you're netting out a profit on every transaction. This is something I'll go into more in future videos, but you can use pending orders to semi-automate your trading. And since you don't have set entry and exit rules, you can take advantage of things like support and resistance levels, and you can set pending orders at those to enter and exit. And if you want to do that, you can create a semi-automatic trading strategy. This is one of the biggest benefits. So like I mentioned before, you can make money even if you're wrong about the direction of the market. This can be a huge psychological benefit for a lot of people. But like I mentioned before, you can make money even if you're wrong about the direction of the market. And you don't even have to have an opinion of which way the market's going to go. You can just do a random entry. So that can be a great benefit to some people. Like I mentioned before, you can roll off a losing trade at a net profit instead of taking the loss all at once. And I'm sorry if I'm repeating myself here, but I think it's important for some people to get these concepts multiple times, because I get a lot of questions about, okay, you can't really do that. How do you do this? So I'm going to have to repeat myself a few times on certain concepts, but just remember that rolling off is the key to success in hedging. And finally, this is a minor point, but some brokers will slip you if they know where your order is. So let's say that you have a profitable account. Some dodgy brokers will shave off maybe half a pip or a pip on your orders because they know where your orders are. But with hedging, you can either do the semi-automatic trading, or you can just do manual trading, and they don't know where your orders are, right? Because there's nothing in the system. You're just entering, exiting whenever you open the charts and take a look at it. So that can be a huge benefit also if you're worried about your broker slipping you. And I'll finish this video with a quick success story. This is Alan. I taught him for about a year. He started in May of 2019, as he mentions. And at the end of the year, I emailed him. I said, "How are you doing?" And he said, "Oh, I'm doing great. Thank you for your help." So this is what he said in his message. "I've been trading the Zen 8 method since May of 2019. I am convinced it is a solid system with great potential. I love trading without a stop loss. I also love that there is so much flexibility, so many ways to trade this. Once you understand the concept and get comfortable with it, you can totally make it your own." So I'm really happy for Alan, and I'm excited to teach this to you also, because I believe that it's a really good option for most people. And if the stats are right, that over 90% of traders fail, and they're trying this traditional method of this entry, this exit, stop loss, then that method might not be working for a lot of people. So it's good to have an alternative like hedging that you can try that will give you some other options and some other ways of thinking about the market.